Today's podcast is sponsored by Delupa. Are you ready to cut through the noise in AI and discover the real impact it's having in financial services? Join me alongside Thomas Lee, the CEO of Delupa, on April 15th at 1 p.m. Eastern for an exclusive webinar where we'll dive deep into the future of AI tooling in finance. We've all heard the hype, but what's the truth behind the tech? We'll discuss how AI is transforming financial workflows and where it's actually delivering value. With Thomas's experience leading a fundamental data company that leverages AI, you'll get firsthand insights into what works and what doesn't in this space. Whether you're managing a hedge fund, analyzing financial data, or simply interested in how AI is shaping the future of finance, this webinar is for you. Don't miss out on valuable insights from industry leaders. Register now at delupa.com/YAV webinar. That's Delupa, DALOOPA.com/YAV webinar for the April 15th, 1 p.m. Eastern webinar, and get ready to uncover the truth about AI in finance. All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on, I believe it's for the third time, my friend and one of my favorite people in finance, Adam Patinkin. Adam, how's it going?
I'm doing well, man. Thanks for having me back. I appreciate it. A double header this week.
You know, long time, I say long time in quotes because listeners don't know this. We recorded one podcast earlier this week. I was hoping to have it up right before we recorded this, but they will hear that soon. And then boom, doubleheader coming back on. Look, we've got a lot to talk about today, so I want to hop into it. I'll start with a quick disclaimer, remind everyone, nothing on this podcast is investing advice. Please do your own work, consult a financial advisor. Always true, but we're going back across the pond to talk about an English stock. So, foreign stocks for my domestic listeners maybe carry a little bit of heightened risk. Everyone should keep all that in mind. Consult a financial advisor. Adam, I'm so happy to have you back on because I think the most frequent request I've gotten over the past year is the Adam Patinkin podcast on Vistry was great. All of my podcasts are my baby, but it was one of my favorite podcasts. I learned so much and had so much fun. People can probably remember that because it was like almost a 2-hour-long podcast. We were jamming so much. So an update on Vistry has been the most requested podcast I've had. Vistry just reported their full year results earlier this week, so we plan to update for it now. I want to dive into everything that's happened to the Vistry over the past year, but maybe just quick, I'll link to the first podcast in the show notes for people who want the background, but maybe just quick 30-second, 1-minute reminder. What is Vistry and kind of what is the overall thesis before we start updating it?
Yeah, of course. And again, I'm happy to go through all of this and share this update. And thanks for having me back on to do this. So I originally came on to the Yet Another Value podcast a little over a year ago. So it was the beginning of January in 2024. And at the time, Vistry stock was around 900p. Over the course of 2024, the company delivered on a lot of the things that we had outlined, and it was up over 50% at one point. And then it went down by over 50% from there, and it is now trading around 600p. Now, just to get it out of the way, I don't want to bury the lead here. At current levels, we have doubled our shareholding. So we have not sold. We have not maintained a neutral stance. We have doubled our shareholding. That is not I'm not telling anybody to do the same thing. Please do your own work. This is, merely me sharing what we have done. And I feel like I owe it to your listeners to talk through what happened and what our views are today and to explain why we've doubled our shares and why we feel that this is as compelling a setup as it's ever been. So I think that broadly is my intro, and I didn't want to bury what my take is or what my evaluation of it is. Obviously, in every situation like this, you run the risk of sunk cost fallacies or being too far in it and being biased. I think we do our very best at David Capital to be as objective and fact-based and evidence-based as we can, and I think that this is the determination that the facts support. So that's where we are. Should I jump into the thesis a little bit? I think it'd probably be helpful to review the thesis. Yeah. So maybe to just jump to the investment thesis, and I know you can go through the full thing in our prior interview. David Capital, our approach to investing, we call value plus a catalyst, And what that means is we are looking for securities that are meaningfully undervalued relative to our assessment of intrinsic value And they have a clear catalyst event path that we can point to, and we can say, this is how an undervalued security is going to become fairly valued over time. And so it's not just that we've got a margin of safety because we're buying a stock that's cheap. It's also that we have the ability to achieve attractive returns based on the time value of money because we've got that clear catalyst-driven event path. In this case, it was a very clear thesis. Vistry had two businesses. One is their partnerships business and one is a house building business. The partnerships business is a crown jewel business. It is a great business. High returns on capital, over 40% ROCE, which is returns on capital employed, is what they call it in the UK. Growing 3x GDP, low cyclicality, asset light, fast asset turns, high barriers to entry, so a significant competitive moat. The dominant number one player, probably 50x or more bigger than the number two. All of the characteristics that you'd look for in a great business, that is what Vistry's partnerships business is. The house building business is kind of the inverse of that. It's a mediocre business. Returns on capital approximately half or a little less than partnerships, so around 20%, growing in line with GDP, highly cyclical, asset heavy, low barriers to entry. Those are all the characteristics of a house building business. And so our thesis was very simple. Become a pure play partnerships business. Exit your house building business. Use the excess capital generated from exiting it to buy back shares that are meaningfully undervalued because the company is being valued as if the whole thing is a house building business. And you essentially can create what we call NVR on steroids. So for your listeners, NVR is one of the three best performing stocks in America over the last 30 years. It's done 30% a year, and they've done it by following this model, being a pure play asset light house building company that uses all excess capital to retire shares, to buy back shares along the way. And our thesis was really that this is even better than NVR because Vistry's partnerships business has higher returns on capital than NVR, is growing faster than NVR, and is starting at a lower valuation than NVR. And you put those three things together, and I think that you've got a recipe for really attractive returns. It's why we're involved here. So, ultimately, that's what our thesis is. It's three things. It's partnerships is a crown jewel business. It's that Vistry is going to become a pure play partnerships business, and that Vistry will use its excess capital to buy back shares along the way.
Perfect. So that's a great overview. And again, people, we tore apart this business model in the first podcast. So people can go listen to that if they really want to dive into different pieces. Let's go to the update. I think things, as you said, are tracking along. If I remember correctly, over the summer, they start the share repurchase, like the share return, capital return was a big piece of thesis. Over the summer, they start that. The stock's ticking along, getting closer and closer to kind of where you're thinking fair value is, or maybe it's a lot higher because it's MVR and steroids. It's a compounder over years. And then, if I remember correctly, it's in October. They have a profit warning. And then in November, they have another. It just keeps coming. So over the past, let's call it 6 months, there have been a lot of profit warnings, a lot of disappointments, and that's leading up to the conference call that they just did 2 days ago where they say, hey, share buybacks are going to be lower, just lots of stuff. So I just want to say, over the past 6 months, what's kind of happened that all these, they called them headwinds. They faced unbelievable headwinds since they released their medium-term plan 18 months ago is what they called it. What are these headwinds they're running into, and why do you and probably the company think these are headwinds and not signs that the thesis is off track or something else is going on here?
Yeah, absolutely. So to maybe think about this from the perspective of the thesis, fundamentally, what does value plus a catalyst mean? It fundamentally means that we are looking for change. We are looking for a business that is changing from one thing to another, from a lower quality business to a higher quality business, from a less profitable business to a more profitable business. We are looking for change. This is not looking for a business to keep doing what it's done for 10 years or 30 years. This is looking for a business that is going to improve itself, and that improvement is what's going to drive returns. But sometimes when there's change, there can be hiccups along the way. And so whenever we look for investments, we're very disciplined in looking for companies with clean balance sheets, with great management teams, and with positive free cash flow. Our view is if you're going to invest behind change, that there almost inevitably will be hiccups along the way. And so you need those three things as buffers to allow you to get through to deliver ultimately the reward that change will bring. And so Fortunately, Vistry has all of those three things. They have a great management team, they have a clean balance sheet, and lots of free cash flow. But to kind of go through what the heck, and so I think that they're going to be able to navigate this. I mean, that's kind of the punchline. They're navigating it. They're resolving the issues. In fact, essentially, all the issues are now almost fully resolved at this point. But let's talk about what they were. So the company is transitioning to being a partnerships business, and the management team used the 80-20 rule. They said, we're going to spend all of our energy on the 80% that matters, which is the partnerships business, and the house building business, which is in wind down, literally just delivering sites until they're done, or selling the sites that haven't been built yet. You sell the land or you sell the partial sites. They're in liquidation effectively of that house building business, and they took their eye off the ball. And the house building business is where the hiccups happened. So there was a profit warning, as you mentioned. There were 3 profit warnings. They were all in Q4. 2 of them were on the same subject and really the same profit warning. I think the third one was a little bit different. But what happened? So they took their eye off the ball. And in one division, the company has 6 divisions. In their South division, which was the only division run by a house building executive and had a significant house building presence in that division, they had a subset of that division, which was all legacy house building. And it came to the management team's attention during their annual budgeting that there were some issues in that house building business, in the legacy house building business. In the UK, you are required, anytime you think that profits are going to come in either 10% high or low from where consensus is, you have to announce it immediately. You can't wait. In the US, you can wait. You can announce it at your next earnings results. In the UK, they require you to come to the market with that immediately. And so the company discovers this on a Friday and they report it on a Tuesday. They race through the weekend and they do their best estimate. And what they estimate is that there's going to be £115 million write down in their house building business. Now, this is a company at the time worth $4.5 billion. This isn't the end of the world. It's a one-time, one-off impact in a legacy business of £115 million. But the market reacts as if it's an ongoing profit loss that's never coming back, and the market capitalizes it. And so essentially the market cap drops by $2 billion, even though it's a one-time £115 million write down. Now, the company then goes through its full review. They hire a fire-breathing auditor to come in and do a line-by-line evaluation of every single business in the entire company, not just house building, but the entire company. And what the audit firm comes up with is that partnerships is totally fine. There are no problems in partnerships. It is great, and all of the targets and earnings power and everything else the company has put out is totally fine. But they were incentivized to pull every possible expense out and report it as a one-off, because the last thing an auditor wants to do is to leave some expenses unfound. And so they pull all of these expenses out, and at their, once they're done with this a month later, the company comes out and reports, hey, it's not 115 million, it's going to be 165 million. So they increase it by 50 million to reflect these additional costs that the auditor identified. Was it really additional costs, or were those kind of one-time things, or the normal course? Some things come in a little bit better, some things come in a little bit worse. I don't know. I think you probably could make an argument that the 115 was the right number, but they came out with the 165, and that's fine. That was it. 165 million write down in the house building business. Since then, the company has said that there are no additional write downs there. There were none in January. There were none this week in March. That has been fully contained. The company has fully replaced the management team that oversaw this, and they've accelerated the exit of the house building business because of this. What is kind of even more important in a way, or just as important, is not all of that is a cash cost. In fact, the cash cost is less than 100 million out of the 165. And so if you were to say, kind of on a blank sheet of paper, what is the economic loss to shareholders here? It's less than 100 million on a business that should be worth many billions. And so when you look at the share price dropping by, between 2 and 3 billion at this point, I would characterize that as a pretty incongruent reaction relative to what the actual economic loss was here. At the end of December, there was a third profit warning. The third profit warning, I'm not even sure if you can even characterize it fully as a profit warning. It was essentially that the company had a number of land sales agreed to. And at the end of the year, some of their buyers noticed that Vistry had these 2 profit warnings, and they tried to chip them. They tried to come in and say, hey, we're going to retrade the price on this deal. And Vistry said, no, we're going to walk. We're not going to do the deal. We'll push those sales into next year and not do them now. And that's exactly what I would want them to do, right? That's exactly what a good management team does. They say, you know what, I'd rather report a profit warning now than to do something worse for the business, especially if I can just re-agree to these deals 60 days from now at better prices. And so lo and behold, what has happened? A lot of these buyers have already come back and agreed to the deals on the original terms. So it was absolutely the right thing to do, but that was a very different thing than the write-downs, which was really just one write-down. It was just they had to report it very quickly and then to report it more conclusively. As a result of this, the share price dropped from 1400p down to 600p. And so, as we kind of think about the investment thesis now, I think that those are the things to consider, right? Where the share price is, whether our thesis is still intact, and how we think about the management team, its credibility, and the business's ability to underline these and to really have them in the past.
So that was a great overview. I've just got a lot of questions. And again, I think, I can't remember if I told you before we started recording or right at the start, but I had so many people who are shareholders, and they said, they've done work here, but they're like, look, Adam is the axe. I really want Adam's take on it. So let me ask, the thesis to me was, as I had one shareholder layout, the thesis to me was 4 points. 1, partnership is a great business. 2, starting in 2024, we're going to generate a lot of cash from the partnership business. 3, starting 2024, because we're shifting more to the partnership business and winding down kind of the high capital, low, more commodity style home building business, we're going to generate even more cash because we're going to release it from that legacy building. And then 4, we're going to take all that cash and we're going to buy back a ton of shares. Yeah. And I do hear you on the profit warnings. I think this comes to a lot of the world, but I guess when I hear that, I say, okay, number 1 might still be true. Probably true. I think the partnership business is a good business. But at this point, number 2 is in question, number 3 is in question, and number 4 is in question. So I look and say, hey, like 3 of the 4 points here are kind of off track. And maybe those are one-time headwinds, but on the call, they're talking about this year, they're really not going to buy. They're going to buy back a little, but it's not the same amount of buybacks that I think everybody was hoping for. The cash flow is looking wonky. I had a lot of people inbounding me and saying, hey, can you help us understand how they talk about getting to their net debt number for the year? And like, those aren't the questions you really want when you've got this great capital light business. Like it just doesn't, right? So I guess I threw a ton out at you. I'd love to talk about all those. And I guess the overarching question that is there, and you mentioned at the end, is like management credibility. You've had, sometimes there's one cockroach in the kitchen, but they had 3 profit warnings, including one they dropped on Christmas Eve. I think people are just like really hesitant around this business right now.
Yeah, and look, that's obviously fair. Like a company needs to reestablish credibility when you've got the profit warnings. But again, it was really one profit warning here, which was around the write-down. So they missed. That's totally on the management team. They missed that in the legacy house building business that is in liquidation. But it was split up in 2 because of how the audit review went. And again, the deferral of some of the land sales, that's not profit lost, right? That's profit deferred. That's not really a profit warning. That's a profit deferral. And so when I look at this, I think it's really one profit warning, and the company has got its arms around it. I think that when you think about the investment thesis, I would articulate it slightly differently. And this gets down to first principles, right? Always think about things in first principles. What fundamentally is our thesis here? Right. And I think it goes to the 3 things I said at the beginning of the podcast, which is number 1, is partnerships broken? And I think the answer is clearly no. I think the partnerships business is every bit as good, if not better, than what we had anticipated it would be. And we know it because the company has now, they put it under review. And then 2 days ago, they formally came out and said, we are reinstituting all of our medium-term profit targets. $800 million of operating profit, 40% returns on capital, 5 to 8% annual revenue growth. And and 12% operating margins in the partnerships business. They did this after doing an exhaustive line-by-line review, not just internally, but using third-party auditors to make sure that this is real and every single line item is fully vouched for and supported. I feel a lot better about that than 12 months ago. You're telling me that it's not just the management team saying it, but they've had an exhaustive analysis done of it at coming from every direction. Like, the partnership's earnings power is real. It's been reaffirmed. They are going to do it. And I think that should give more confidence in the thesis, not less. The second one is, are they going pure play partnerships? On the earnings call, Greg Fitzgerald, the CEO, came out and said that they have moved more in the last 3 months towards a pure play partnerships business than they had in the prior 12 months combined. And to me, that's music to my ears. That's exactly what I want to hear. This is, I think that they're recognizing just they got to get out of house building. That's where the issues are. Partnerships is beautiful. And they're accelerating their exit from house building. They have replaced, essentially the entire leadership team at Vistry is now 100% partnerships people. There's no one left from house building, and house building is aggressively being wound down. Can I
just pause you there? Because the 3 months, more than we did in the past 3 months than we did in the prior 12, it was one of the lines that really jumped out to me, because I was like, look, this is what you want, right? Like, if you think partnerships crown jewel, you want them running to it. But I guess it also, maybe this is because I'm a little skeptical at this point too. I was kind of like, the hot dog meme where the guy is in the hot dog soup and he's like, we're all trying to find the guy who did this. I kind of looked at it and I was like, well, you guys were in charge of the company the prior 12 months. So I love that you've got a fire lit under you the past 3 months, but like, why did it take the profit warning and everything? Do you think they were, I don't know. I was just, it's not like they took over and then they said, oh, those prior guys weren't moving fast enough. Like, they were in charge the whole time. So do you think it was just the profit warning, like, dawned on them, hey, how risky the home building business was? Or do you think there was something else going on with that?
Yeah, I mean, I think that the main answer that I would have is that they were so focused on the partnerships business and growing the partnerships business and putting the institutional, foundation behind it, getting the system set up, getting all the processes right across, what's going to be a very large business over time, and is the number one house builder in the UK right now, that they weren't focused on house building. They said, you know what, these are house building guys. We're going to let them run, and then these businesses will run off, and then they'll disappear. They weren't as hands-on, and this is the fault of the management team. They weren't as hands-on with the house building business. Oh man, has that changed, right? This is very much in the center of the sights of the management team to make sure that there are no more problems in house building and that this business gets gone, that it gets exited. And so, I think that you're progressing where this business is going to be a pure play partnerships business faster than what we had been baking in when we first did our podcast interview. This is coming a lot sooner. And I think that's a good thing. As soon as this is a pure play partnerships business, again, partnerships has had zero issues here. As soon as this is a pure play partnerships business, that is the biggest risk off the table for the investment thesis for Vistry, and this thing can fly. And I think it's really good that they're accelerating towards being a pure play partnerships business. The last point I just wanted to mention, the buyback of the shares. So they actually accelerated their share buyback a little bit this week. It wasn't a whole lot, but if you look at it, they bought back. I think that they said they bought back 38 million pounds over the last 6 months, and they're going to buy back 92 million pounds by the beginning of 2026. So essentially over the next, call it 9 months, they're going to be buying back 92 million pounds. And so, I don't know, that's something like a 50% increase in the share in the pace of the share buyback. Let's see if they actually do it or not, but that's what they said.
Okay. Go ahead.
But I don't think that that's where our focus should, like, they're buying back shares every single day. And I hope that they continue to do it more aggressively, but I think that they will buy back more aggressively. And I think that there can be potentially some special, some extra share buybacks that come in. And the reason is, in a way, it answers the question, why hasn't the share price recovered? And why has David Capital doubled our position size? When you look at Vistry's business right now, the partnerships model, I think if you remember from our first conversation, it has a diversified customer base. They really are selling to three different end customers. One is PRS buyers, which are large institutions that are buying units to use as rented stock. So they're going to go out and rent them to people. The second buyer are open market sales to homeowners who are going to live in the properties. And then the third one is affordable housing that they're selling to housing associations, which are not-for-profits that buy and manage affordable housing, or to government entities, especially to local authorities, which are essentially regional governments in the UK that also maintain affordable housing stock. PRS sales are very strong right now. They're up nicely year on year. Open market sales are very strong right now. And Vistry came out and said that PRS is doing very well and that they are experiencing a bump in open market sales in line with where the rest of the sector is. And so really, the stock fell a little bit this past week. And I think the most important reason it fell was because the Vistry reported its sales rates did not have quite the same pickup that other house builders have been reporting. And I think that people have been asking, why has that been the case? And all of it has come from affordable. And the reason why affordable sales have been a little bit lighter is because the UK government operates through 5-year plans where they allocate a certain budget to affordable housing. And under the most recent 5-year plan that the British government came out with, it was essentially just over 12.5 billion pounds that the government allocated to affordable housing over 5 years. It was just over that, so it was actually about 2.6 billion pounds per year. We're coming to the end of the 5-year plan, and so by this point, almost all of the funds have been allocated. And there's kind of an air pocket that we're hitting right now that started in Q4 and into Q1 a little bit, where the new Labour government has come out and said very strongly they're going to allocate a ton of money to affordable housing, but there wasn't certainty around when that money would come through and what exactly it would look like. Now, the Labour government has topped it up not once but twice. So they took the 2.6 billion this year, they added 500 million to it. I mean, even though the UK government, their budget is in not perfect health right now, they added 500 million to it to take it from 2.6 to 3.1. Then they topped it up again from 3.1 to 3.4. So these are really positive signals. And then ahead of them announcing a new 5-year plan, which, I mean, look, it could be 3.4 a year. I don't know, but it's trending towards being a really large number. And then the day before Vistry reported, the UK government came out and said, hey, we're going to do an extra 2 billion of funding, and we're going to get it out the door now. And even in the last 72 hours, I'm hearing from our channel checks that the government is basically telling everyone, we want this money out the door in April. We want 2 billion more funding, which, by the way, can be levered 3 to 1. 2 billion out the door. That is massive. And so I think that what you're going to see is, it's not Vistry's numbers. Vistry did not bake in, and when they reported, it was too close. They'd already set all their budgets. They'd set what the press release was going to look like, everything else. There is nothing in Vistry's numbers for this year for that incremental 2 billion of affordable housing spend. We know PRS sales are running really well. We know open market sales are running really well. The only thing that's been lagging is affordable. And our view is at David Capital, you're going to see a massive catch up here. I think the market has missed this. The market has totally gotten it wrong. Vistry is positioned to do beats and raises through the rest of this year off the back of this significant affordable housing spend bolus that just came through from the Labour government. And maybe just one last point on the Labour government, as long as that's the subject here. Yeah. The Labour government has been so much better than even I had anticipated for what Vistry's doing. They have made it a central part of the government's program to make sure that the housing sector and construction and infrastructure, all of that, but building is what they are focused on to juice GDP. And when you look at even the GDP forecast that the Labour government has come out with, they are projecting the primary driver of accelerating GDP growth over the next 5 years to get to a balanced budget and everything else in the UK is all about more construction, more building. This is central to the next 5 years of UK government policy. So what has Labour government done? They instituted mandatory housing targets where they are essentially forcing local authorities across the whole country to meet minimum house building targets so that the government can reach 1.5 million new homes over the next 5 years. That would be essentially 300,000 homes a year. This past year, the UK built something like 215,000. And because you can't just turn it up to 300,000 immediately, that means that by the last couple of years, by years 4 and 5, to make up for year 1 and 2, they'll probably be having to do 350,000 homes a year. So you're talking about an increase in build of as much as 50% over the course of the Labour government. Even if they don't hit those targets, it's still a massive increase. They've changed planning approvals from a default no answer on brownfield ground to a default yes answer on brownfield ground. So automatically, brownfield regeneration, which is what Vistry does, now has a default yes answer from planning authorities. They've gotten rid of environmental mandates. There's a famous story in the UK about a highway that they're building there, and there was a newt that was endangered, and they ended up spending £100 million building a tunnel around where the newt was. And so it got a lot of press, and the Labour government is saying, look, we're not going to spend £100 million on a 50-foot tunnel to go around newts anymore. Labour has launched a new towns policy where they're building whole new towns where none existed before. They've streamlined the planning process, hired a bunch of additional planning employees to accelerate the permission process. They've allocated £600 million for skilled labor training. They're reducing the requirements on banks when it comes to the LTV on mortgages. If you try to get a mortgage right now in the UK, it's really hard to get a mortgage at anything more attractive than like a 25% down payment, literally a 75% LTV. That's totally unnecessary. You can do loans at 85% or 90% and be well protected. It looks like that's where the policy is heading for Labour. And then on top of all of that, Labour has now been openly talking about bringing back a program called Help to Buy, which was a major driver of demand, especially for first-time buyers. No guarantees that happens, but man, would that be a shock to demand, like a positive shock to demand if they do it. And so when you look at all of these things, I'm looking at a situation here where Vistry is now trading at the lowest share price, or a much lower share price, with much more certainty around the profitability of the partnerships business, much closer to becoming a pure play partnerships business. And in the meantime, the company has bought back millions and millions of shares. To me, obviously, the negative is now you got to prove it. You've gotten back-to-back announcements where there's been no further profit warnings, right? Back-to-back, they've been good. And so you're in the process now of rebuilding that credibility. But the reality is that this stock is now trading at a lower price with more certainty that our thesis is going to be right.
Oh, so, I love to hear all about the, it's cliche, but I love to hear that the Labour government is taking basically a YIMBY approach to building. You know, I wish Manhattan, I said, I'm thinking about, you live in Chicago, which doesn't have it much better, but I'm thinking about leaving Manhattan. One of the reasons, like, hey, the rent is how much at this point? I love it, but neither here nor there. Let me ask, okay, so you've got all these great tailwinds, right? Everything seems like it's lined up. The headwinds in the management's way of saying are like they were real, but they've been dealt with. A lot of it was self-stub. A lot of it was in the legacy business.
And by the way, I don't think that they were macro. I think it was a management error in the house building business. I don't think that this was, aside from the reduction in affordable spend because of this little air pocket that we've gone through, but now is essentially over. I think that this was a self-inflicted mistake that has been corrected now.
Air pocket's over. They do say the day before the earnings, they get the labor acceleration. It's in the press release, but maybe it's not fully in the numbers. They say, hey, we're going to have...
It was not in the numbers at all. They did not change any of the numbers.
H1, momentum into FY26. So let me just ask, the medium-term targets they have, right? 40% return on capital, all this type of stuff. As part of the earnings, they say, hey, we're still committed to those medium-term targets, but we're no longer giving you a timeline for it, right? It's just some indefinite number in the future when we're going to hit those medium-term targets. And I understand management's maybe thinking, hey,
they never gave a timeline at the beginning. There was never a timeline on this. No, there was never a timeline. They always said that there was medium-term targets, but they never gave a specific timeline on when they would be hit.
Okay.
When I hear medium-term, I'm thinking over the next 3 to 5 years.
Yeah,
right?
so maybe I was misinterpreting it, and I'll try and pull up the results real quick. But when I heard the medium-term targets, which I think they first gave in 2023, my first thought was this is a 2027, maybe 2028 target. And I think they said, I'll try and find it, but I thought they had basically said, hey, the timeline is extended, is what they were saying. And I just hear like, hey, it was short-term headwinds. We've got all this like accelerating momentum coming in. And I was kind of surprised that I felt like they were lengthening the timeline to hitting the medium-term targets.
Now, look, again, I don't know exactly what the year is that they're going to hit it, but let's say they did. Let's say they extended it by a year. I think that there's good reason for it. And it's the South Division, right? They've had to go in and essentially pause growth in the South Division for a year as they got their arms around the issues and fix those issues. And so to the extent that there is any delay, I think it's not emanating from the other 5 divisions. It's emanating just from the South Division, and they're getting the thing in order so that they can reaccelerate their growth there.
The quote was, all we've done is simply remove the timescales. So I don't know if they were just saying this is a 3 to 5 year. Yeah. Okay, cool.
They never had one at the beginning, and that's fine, but they're going to get there. So, I mean, when you look at the numbers right now, and maybe this helps to talk about the numbers, the company just did 360 million of EBIT this past year. So in 2024, they did 360 million of EBIT. They are guiding for a notable step up in operating profit in 2025. So I don't know what that number ends up looking like, but it could easily be 400 million plus, right? And I think that it's going to accelerate as the year goes on. The company was very clear that there's a lot of these legacy projects, including legacy house building projects, that are rolling off in the first half of the year and being replaced by much higher margin projects in the second half of the year that then should continue going forwards. And so I think that in the second half of the year, you're going to reset the profitability base of this company at the same time that you're seeing, again, this bolus of spending coming through from affordable housing. And by the way, that affordable housing spend, it could step up even more from there as the company, or as the Labor government puts in place its new 5-year affordable housing spend targets. So I think that there's a really clear path here to be doing north of 400 million of operating profit, and clearly on the way to 500-600 million of operating profit within the next couple of years, alongside a freshly pure play partnerships business. And when you look at that, and eventually to the 800 million of medium-term targets, when you look historically at multiples of partnerships businesses and house building businesses, house building companies over time have traded at about 1.5 times book value.
Yeah.
Partnerships businesses have transacted at anywhere from 5 to 7 times book value. Right now, Vistry is trading at 0.8 times book value. When you look at an earnings multiple, historically, partnerships businesses have transacted at 12 to 13 times EBIT. Right now, let's say that Vistry is going to do 400 million plus of operating profit this year. You're talking about a business that's trading at 5 times EBIT on this year's numbers and 2.5 times EBIT on the medium-term target versus transactions at 12 to 13 times EBIT. It's just not the right number. It's just not the right valuation here. So that's the kind of upside I think and they're buying back shares every day, right? So that's the kind of upside potential I think that you're seeing here. And again, the issues are behind the company now. There's been no more write-downs for months. They've got their arms around the house building, and now the business is accelerating as it becomes a pure play partnerships business. The margins were going to inflect in H2 anyways, and then this affordable housing spend on top of it. I don't know. I think that people have missed the crux of it. They've missed that this business is accelerating. And I think that, it's kind of one of these things where you're allowing too much of this kind of one-off, issue that the company had in its legacy winding down business to overshadow what I think is a wonderful kind of crown jewel asset they have that's going to be the entire business here pretty soon.
Let me ask two questions on the debt balance. And
Yeah.
I think this speaks to people being a little bit gun shy with this company right now, because they guided, if I remember correctly, hey, our FY25 this year's our debt balance is going to end lower than FY23, if I remember correctly. And I had a lot of people, and I think you and I are both members of VIC. There was a lot of debate on the VIC boards. I had a lot of people reach in, and one person humorously said the math isn't mathing. Like, a lot of people are struggling with the guidance on the debt balance. And again, I don't want to get like hung up on accounting or something, because I think there's a really nice story. There's a really nice story, accelerated momentum, things to believe. But I think the fact that people are getting hung up on this debt guidance and the math there speaks to a little bit of it. So I'd love to just ask you, like, kind of how do you make sense of their debt guidance? And then I have a follow-up question on the debt.
Yeah, I mean, look, this is a low debt company, right? It just doesn't have very much debt. We're talking about a business that had under 200 million, about 180 million of net debt as of year end, and did more than twice that in operating profit. Not even EBITDA. I'm just talking about EBIT. Did twice that this past year. Look, you can look at the debt balance another way, which is to say, what is the average net debt over the course of the year measured on a daily or a monthly basis? And that would be higher because the company gets a big cash inflow at the end of the year. And so, even if you were to say that the average daily debt, net debt balance is £500 million, you're still talking about a business. If they do over 400 million of operating profit this year, it's trading not much above 1x net debt to EBIT. That is not a high debt balance. That's a very manageable, moderate debt balance. I think that where people struggle is just that house building companies run net cash. And the reason why is because they're so asset heavy. If you run into issues where all of a sudden the market stops and you need capital, you can't get it because all of your capital is tied up in the land and in the projects, in the house building projects, because your asset turns are so low, right? You might only have an asset turn of under 1x a year. Whereas a partnerships business, you might have 3x asset turns. And it's just a very different set of financial conditions for this business, for a partnerships business, because you have much readier access to capital. You don't have it where you go into a downturn and then you're just stuck and you need that cash balance to rely on. Because the partnerships business is consistently producing capital, and because you have such high asset turns, you have ready access to capital always. And so you can run at a modest net debt position. 1x net debt or close enough to 0x net debt on a year-end balance, those are, I think of it as a red flag if it goes above 3x net debt to EBITDA. We're nowhere close to that here.
I really like that they're also breaking out the average daily debt balance, because I got a lot of questions from people, not just the year-end debt balance, but, as you said, especially on the home building side, like it fluctuates up and down and all this sort of stuff. You get cash at the end. I like that they're just saying, hey, we're just going to give you the average debt balance, so we're not playing games and being like, yeah, oh man, during the month we're running from the 2nd of the month to the 30th of the month, we have 4 billion of debt, and then on the last day we managed to pay it all down, and then we borrowed back. Like, I think that's
transparency is good. Yeah, transparency is good. So yeah, but it's not a levered business. It's a very, very modest amount of debt and something easily manageable. It's just sometimes house building analysts struggle with it because they're so used to businesses that always are running with net cash. And look, I know what that is. In 2008, during the financial crisis, the hedge fund that I was at, we were short all of these companies, right? We were short the mortgage lenders. I mean, we were watching as house builders were going bankrupt and collapsing into each other's arms. Like, I know what that looks like. And back then, the traditional house building businesses were levered. And so now they run with net cash. And I think that's a much smarter thing to do, but it's just not the case for a partnerships business. It's a different model with different characteristics, and it requires a different financial profile.
One more thing on the debt, and this might be very British of them, right? Because I've seen this at a few of the British companies I follow. Like IWG is one that comes to mind, where they say, hey, our franchise business is taking off. We're about to experience a real acceleration in cash flows because franchise is asset light. Like we're going to see this real acceleration in cash flows. We can't wait to buy back stock. But by the way, we like must bring our net leverage down to 1x before we can like really lever this up and start buying back shares. And I say this because, they say, hey, we had some headwinds, yes, a lot of them self-inflicted, but the acceleration is here. The labor government budget, the affordable housing, it's all here. We're going to see accelerating momentum in the back half of the year and especially into 2026. And then they say, hey, we're going to end the year with a debt balance lower than we had in FY23. And I'm trying to pull up my notes. And they say, hey, in 2024, if I'm just looking at the cash flow, we bought back 170 million of stock in 2024. And this year, I think they said 92 million through the end of the year on top of the 38 million they've already done to date. So if I do the math there, it's 130 million. So what I'm hearing is accelerating momentum. Things are getting better, but at the same time, we're going to be paying down debt and reducing our share repurchase while our stock price is lower. I'm like, oh, I don't know if that's very British of them or if there's something else going on, but like, it's hard for me to match. I understand like companies are not stocks and they need to run with the margin of safety and everything, but I'd rather than be leaning into it. Do you see what I'm saying? I'd just love to get your thoughts on that.
Yeah, remember, this company, like all companies, has a lot of different audiences that they're appealing to. And one of the audiences that they're appealing to is their customers, which are primarily local governments, not-for-profits, government authorities, right? And so you don't want to spook them. And it's really easy to say, hey, we're going to have less net debt a year from now than we have today. And that's the kind of thing that gives those partners a lot of comfort. And so I don't blame them for that. Now, what that gives them, though, is a lot of wiggle room. Because if the business accelerates the way I think it's going to accelerate, as all of this affordable housing spend comes through, and after last year, you bet that Vistry did not guide aggressively for this year. They have set expectations as low as they can so that they can make sure that they are absolutely not issuing any profit warnings going forward. This is a beat and raise story from here on out. They are absolutely not having another hiccup here. I mean, they're making sure of that. I think then it opens up the door where you can expand the buybacks, right? If the cash flows are coming in better and all they've guided to is that net debt is going to be less than the prior year, every little bit of incremental profit can go to incremental buybacks. And in fact, on the call, the company said that. They said, look, we'll assess where things are as the year progresses. And if our cash flows are coming in where we expect them to be, we can evaluate more share buybacks. It's on the table.
Two last questions. You framed it one way that I've toyed around with this investment, this company in this way several times. Hey, at today's prices, you're paying below tangible book value for the company. So
yeah, so you can literally liquidate the whole company and get more than your money back. Now, obviously, you would not want to do that. This is too good of a business. Don't liquidate it. But it just shows you how kind of crazy the multiple is right now.
No, that's exactly. So I guess, some part of me says, hey, you buy Vistry and heads, Adam's right, partnership's a great business. The cash flow starts rolling in. All the working capital they're talking about drawing down, getting down to home building. Heads, you win massively. And then tails, cool, it's trading below book value. Maybe we're wrong on the partnerships, but it's trading below book value. Like you have this firm asset protection, which is generally, I generally like when I have like asset protection plus capital light multiple compounder upside. I realize I am preaching to, I am speaking your book, but I guess, is that the right way to think about the risk reward here? Again, I know that's a softball question, but I'd love it if you said, hey, no, if you told me no, like there's something about the tangible book value that's in question or something. I think that's probably what the market's saying because of the write down. I don't know. That's the way I've been toying with it. But to date, I don't know. I'll stop there. I'm rambling, but it's just the big debate I've had internally with myself.
Yeah, look, it's an appropriate framing, but it's not the framing that I would necessarily use just because in my experience as an investor, and look, everybody, I think I preach this a little bit, but you have to figure out as an investor the approach that works for you. And there's some approach that works for everyone. And for some folks, it's growth investing, and for some folks, it's quality investing. For some folks, it's dumpster diving. There's lots of different ways to get to heaven in investing. And because you do it one way and I do it a different way, it doesn't mean that both of us can't get to heaven. We can. That's kind of the beauty of how it works. And so for me, value plus a catalyst makes a lot of sense. In my career, in my investment track record, I have found that margins of safety are better if they're cash flow based than asset based. And so, yes, it is to a certain degree a margin of safety if you can liquidate the whole company and get more than your dollar back from doing so. But is Vistry going to liquidate? No, Vistry's not going to liquidate anytime soon. And so really how the stock is going to move is going to be based on cash flows. And if you keep your eye on the ball there, if you really focus on cash flows more than anything else, I think that that's how you can find stocks that are going to perform well. And so in a way, my thesis here, it's not about that. I mean, look, again, that's not an unreasonable framing to say that you're buying it below book, but what I think gets me more excited is the idea that free cash flow and cash flow overall is going up. It's going up as the business transitions to being pure play partnerships, and it's going up because you got the tailwinds of affordable housing spend. So I wouldn't spend too much focused on the asset value. I'd focus more on the cash. That's my approach.
No, A, I love how you framed that. And B, I love how you framed that over here.
Yeah.
I love how you framed it, because you are right. When you said you have more success with cash flow based margins of safety than asset based, I have found more success and more conviction and stuff being able to develop asset-based margin of safety with cash flow kickers, which I think why this under book value appeals to me in that framing. But I just love how you said that, because you are right. And one of the big things with investing is finding investments that fit your style, because you're going to research them better and you're going to have a better ability to build conviction and think them through and everything. So I just really like how you framed that. Last question, and then I'll turn it over to you to hit anything that we missed and wrap it up. All investing is opportunity cost, right? Technically, we should be comparing an investment in Vistry to, buying a restaurant in Istanbul versus, name everything else on the planet. But a lot of times it is interesting where you say, hey, let's just compare it to the direct peers. And I had several people mention, hey, there are other home builders and home building companies listed in London that focus on the UK that are trading below book value. There are companies, post the craziness that has been March. There are home builders in the US that trade pretty cheaply. I think Lennar is getting close to 1.1 times book, and I think that's pretty capital light post spinning off Millrose. I haven't done tons of work there, but there are several other home builders that are trading at or below tangible book in the US. I think I know what your answer is going to be, but I'd love to just briefly touch on, this is no longer just Vistry trades cheaply. A lot of the industry is trading cheaply. So why is Vistry the horse? Why is Vistry the better kind of opportunity cost versus these kind of direct pure play comparisons?
Yeah, I mean, look, I have for sure. I mean, this, but I think that inflation is well anchored. It's under control, and I think interest rates are likely to go down over time. And I think that kind of tailwind, I know that's a separate discussion, but as you look at real-time data, whether it's shelter data or car data, or even which are the two primary components that go into CPI, there's a catch down that's happening, and it's very hard for me to do any math that shows that that inflation is going to get out of control, because you've got this weight on the numbers from shelter kind of mean reverting back to where it's been more recently, which is essentially not much growth at all in shelter costs in the US. And so as that happens, that should be a tailwind for any company that's interest rate sensitive, including all of the companies that you just mentioned. And so am I negative on the sector? Or am I negative on any of these companies? No. I just think that there is something not sector driven, but company specific about Vistry. And that is that you have a wonderful business that is far more valuable than any of these traditional house builders, and it's trading at a multiple that's actually the same or even below these house builders. And so you're going to have a situation where you can have the Lollapalooza scenario that Charlie Munger always talks about, right? What is the best investment you can make, period? It's where profits go up and the multiple goes up. It's where you have both. It's not just the multiple. It's not just earnings. It's both. Vistry is positioned to substantially grow its earnings power, or grow earnings over the coming quarters, years, as they become a pure play partnerships business, and as this bolus of funding comes through, and as they exit the lower return projects from house building. Profits are going up, and the partnerships business is going to become 100% of this company, which should mean that the multiple goes up. And when you're starting at the same multiple as other house builders, or even lower than other house builders, that means that the multiple re-rating can be really significant here. You could go from under book value to trading at 3 or 4 or 5 or 6 times book value. That's entirely possible, on top of the profitability step up. So would I buy in the UK, Barrett Redrow, or would I buy Persimmon, or would I buy Barclay Group? No, I mean, there's nothing wrong with those businesses. Those are all fine businesses. But why buy those when I can buy at a lower valuation the best business in the sector right as it's about to hit a profit inflection? I mean, that's, to me, pretty clear which one I would rather own.
Look, I will make this a softball because we're running quite long. This was supposed to be a 30-minute update, and we're over an hour at this point. So I'll make it a softball, but if I'm wrong, please tell me. I'm just looking through my notes, and the one thing I didn't hit was, again, they're transitioning to the partnership business. So I thought net assets were going to come down, which would cause to release a lot of cash flow. And if I just look, it's a chart from their earnings release. Tangible net assets, 2.15 billion in 2023, 2.22 billion in 2024. I suspect the reason is those delayed sales at the end of the year that you talked about and addressed earlier. So you can give me a yes or no, but if I'm wrong, I'd love to ask, because a question that I had when I was first researching is, why is the tangible net assets not coming down? I thought that was part of the thesis.
Yeah, so they've come down a little bit since the transition started, but the reality is, I think, 2 things. One is exactly what you said, which is that they had to defer some land and project sales, that if they'd had those go through, obviously the net asset value, the capital employed in the business, would have been a lot lower. The other bit to it is the company has come out and said that there is a real opportunity in reducing their works in progress, their WIP, and they actually quantified it. They said there's a 200 million pound opportunity, and the company has reiterated now that it's going to get down to 2 billion of capital employed. I think right now the company's total capital employed is about 2.5 billion, down from between 2.7 and 2.8 billion when they started the transition to a pure play partnerships business. And so if you do this, if you accelerate the exit from house building, which appears to be happening over the last 90 days, plus you pull some money out of WIP, plus you continue to build out and exit house building projects along the way. So not just doing larger sales, but also kind of just finishing the projects and not replacing them with new house building projects. You put all of that together, and I feel really good that the capital employed in this business, 2 years from now, 3 years from now, it's going to drop to 2 billion or just below 2 billion. And by the way, that's how the math checks out. If you do a 40% ROCE on 2 billion of capital employed, that's how you get to 800 million of operating profit.
And I'll just, again, this is at this point, if I'm looking correctly, an under 2 billion market cap company. So you go from 2.2 billion. I'm just looking at tangible net assets. Capital employed is a little higher. One or the other, you drop it from that to 2 billion. It's a significant piece of the market cap getting freed up in cash there. So Adam, this has been great.
Yeah.
My notes were extensive, and I think we hit everything inside of them. Anything we should have hit that you think we missed, or anything that you kind of want to leave listeners with as we wrap this up?
Yeah, I mean, I think that I would just say that, it's good to have conversations like this, because no one bats 1,000 in investing. You do the best you can, but no one bats 1,000 in
this
investing.
Month, it feels like, for me at least, it feels like nobody bats 250.
Yeah, right. And so all you could do is go to first principles, right? Be fact-based, be evidence-based, look at the data, do your homework, and then try to make the best decision that you can. Ultimately, when you look at Vistry, I just think it's so important to stay focused on what our thesis is. Partnerships is a great business. This company is rapidly becoming a partnerships company, even faster than it has before. And ultimately, you can see it every single day because they have to file it. This company is buying back shares every single day at really attractive prices. And I don't think that I'm the only one who's noticed. I don't know if you saw it, but earlier today, there was a filing from Anson Funds, which is a really well-respected hedge fund up in Toronto. They just took a significant addition to their position here in Vistry and became a filer. Smart money is noticing this. And over time, I think that shareholders will be rewarded here. At least that's what our view is, and that's where our money is.
Perfect. Well, all right, March 2025, the most popular request I've gotten, the update on Vistry. I am looking forward to our March 2026, where we say, hey, 2025 was great. It's a 5-minute podcast. 2025 was great. Everything they said and more, and the buybacks are starting to ramp. But Adam Patinkin, David Capital, this has been awesome. Thanks so much for coming on twice this week, and looking forward to having you on for the 4th time.
All right, great. Thanks for having me, Andrew.
Today's podcast is sponsored by Delupa. Are you ready to cut through the noise in AI and discover the real impact it's having in financial services? Join me alongside Thomas Lee, the CEO of Delupa, on April 15th at 1 p.m. Eastern for an exclusive webinar where we'll dive deep into the future of AI tooling in finance. We've all heard the hype, but what's the truth behind the tech? We'll discuss how AI is transforming financial workflows and where it's actually delivering value. With Thomas's experience leading a fundamental data company that leverages AI, you'll get firsthand insights into what works and what doesn't in this space. Whether you're managing a hedge fund, analyzing financial data, or simply interested in how AI is shaping the future of finance, this webinar is for you. Don't miss out on valuable insights from industry leaders. Register now at delupa.com/YAV webinar. That's Delupa, DALOOPA.com/YAV webinar for the April 15th, 1 p.m. Eastern webinar, and get ready to uncover the truth about AI in finance. A quick disclaimer, nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.